This is the second lecture on risk and return. And in this lecture, we're going to sort of think about historical stock market performance. So we're going to look backwards. And, the largest part of this unit is thinking about trying to calculate returns looking forward. So if we're trying to make a new project or a new investment, what return should we ask for in a forward-looking sense? But to look forward, we tend to need to understand what happened behind us. Now, it's not great to look at history to predict the future, but it's kind of going to be what we have to do at the end of the day in here. So here we go, historical risk and return. So in this unit, we're going to talk about the difference between historical return and future return. We're going to calculate some averages, a standard deviation, and just sort of look at historical stock market performance for certain types of investments. And hopefully at the end of the day, I can also sort of get you thinking about personal investing long term. The historical return for an investment is what we earned actually over time. So we're not assigning probabilities or anything like that. It's actual data, actual prices. We'll calculate a return from the prices and dividends and figure out how a stock did. Now, just like we did in the previous unit, percentages are better than grand totals. Because when you look at a stock on a percentage basis, you can compare any two stocks. If you look at it on a dollar basis, a stock like Google that trades at about $800 at the time of this recording versus, say, a stock like Synovus that trades for $2.50 at the time of this recording, you just couldn't compare them. It's apples and oranges. But if we look at how they did in the last month or day on a percentage return, now that's a better way to think about it, because that's actually what am I earning on my investment. So consider this following example. Hit pause if you need to look at the numbers. But essentially we got prices and dividends, and we're going to calculate returns off this. Now think about the previous lecture, Risk and Return 1, where we gave an overview of risk and return, but we had the return calculation formula, where we had the gain in price plus the dividend divided by the initial investment. And we're going to do this 1 year at a time. So we'll have a return for 2005, 2006, 2007, 2008. Notice we'll have 4 returns here. Now we got 5 years of data, but for the first return, we need the beginning of the year or the starting point. So our first return is actually going to be 2005. So you see below, I used the return formula and calculated the return for each period. You may want to hit pause here and verify the numbers yourself. But notice we have 4 individual returns. So we can do a little bit with this data. We can calculate an average on this data. We can also calculate a volatility or variance. And that's what we're going to go through now. So let's start with the average. The average is just an arithmetic average. We're just going to sum up the individual returns and divide by the total number of returns. So here we got 4 years of returns that we calculated. So we'll add up our 4 returns and divide by 4. So here when we do this, we get 6.88% per year. That's called our arithmetic average, or average performance of this stock. Our second measure is what we call volatility. Volatility calculates, or this is sometimes called variance, how far from the average does each return fall. So you could have 2 stocks that have the same average, but one has returns that are right on the average every time. It would be a low variance investment, versus one that's way above and then way below, but still ends up with the same average. Now, one would be considered pretty safe, one would be considered pretty volatile. So that's what we're trying to get at here. When you calculate volatility, you're basically calculating the chance that a return could be way off from what you expect. Okay? And of course, in general here, the greater this volatility, the greater the risk. And if we start thinking forward-looking, the greater the volatility, the greater the return I might ask for in the future. All right, here we go. I have a column of returns there. And now the next column just shows us calculating individual variances for each observation. So I take the return and I subtract the average and I square it. Okay, we square it because some returns are above the average, some are below. If you didn't square it, you'd just be adding up pluses and minuses and they'd all cancel each other out. So we square each one of these, we're going to add them up, and we divide by n minus 1. Because we're estimating something here. Now, if you haven't had stats, this might be a tough thing to get your head around. If you've had stats, you've seen this. We lose a degree of freedom for those of you who've had stats. So we divide by 3. So our final answer here is 0.0177. But the problem with variance is you have square units, and square percent doesn't have much economic meaning. So we're going to go ahead and take the square root of this, and we get 0.1329 or 13.29%. So now I have two ways to describe a stock. I have its average return and I have its volatility. So basically I have two dimensions to describe a stock, two ways to compare. Now we'll apply this in the next lecture. Let's look at this in a grander context. This was one stock. So let's look at the performance of overall stocks. If you look at historically, from 1926 to 2008, they update these every year. You just don't really get them published for a few years sometimes. So here, if you look at this, small company stocks average 20.9%, S&P 11.6%, all the way down to inflation was 3.1. Now look at the second column. I know these columns don't line up real well, but the second column shows you the volatility. So our small company stocks did better on average than all the other types of investments, but they also had the greatest volatility. If you look down at U.S. Treasury bills, that would be considered a very safe investment. Its average return was only 3.9%. Its average standard deviation, or its standard deviation for the sample, was 3.1%. Very safe, but very low return. So this is sort of tying into our overall theme here in this class. The greater the volatility, the greater return I'm going to get. So in other words, nothing ventured, nothing gained. Small company stocks are these companies that a lot are going to fail, some are going to be very successful. So there's a lot of volatility there, but that's why there's also a lot of upside. So the point is, when you're young, like most of you guys taking this course, you can handle volatility. You know, you can lose a lot of your money, but you can stick with it and you can earn it all back, right? Now, when you get to be 65 and thinking about retirement, volatility is not necessarily your friend. But when you're 19, 20 years old, you've got 40, 50 years to get the money back. So keep that in mind as you start investing down the line. All right, so if you look at this graph, it just graphs what we just saw, but clearly the greater the return, the greater the risk. So if you can tolerate the risk, you want to be up there in the large company or small company stocks. So that's the key thing there. You want to be in equity, especially when you're young. If you don't want to tolerate risk, you're down on the other end of the graph. So, sort of concluding what I said, nothing ventured, nothing gained.